Hi everyone, thanks for tuning in. Welcome to another of our Artemis Live video interviews. And today it's my great pleasure to welcome Christian Mumenthaler, the Chief Executive Officer of one of the largest reinsurers in the world, Swiss Re. And Christian's joining me today to discuss some of the key issues facing the industry at this time. So welcome, Christian. It's really good to see you again.
Thanks, Steve, and thanks for having me.
Sure. It's been an interesting year since our last interview, and the world's continued to come to terms with the pandemic. The insurance and reinsurance industry continues to face a range of pressures, from catastrophe and severe weather through to climate change, while technology and disruption still big topics for everybody. And we're also in an inflationary economic environment, or the beginnings of one as well, it seems. And perhaps I could ask you to begin by just providing a bit of color as to Swiss Re's position regarding the pandemic. Do you feel the company's weathered it well? Could there still be some surprises to come?
Yeah, I think, Steve, if you asked our people, I think we're incredibly proud how we weathered the pandemic. And I think the same is probably true for my competitors and my clients. I think the insurance industry overall has done very well, could adapt very quickly to the digital world without too many issues, and was ready all the time to pay claims and be there for their own clients. I would say on the other aspects of the pandemic, not just the business continuity aspects, we were very happy that we started to work on the asset side very early on. We had the pandemic scenarios. We knew in February already that it would probably spread worldwide. So we started to de-risk the asset portfolio, which has served us extremely well later in the year. I think we also had a relatively early realistic assessment of the overall loss, which maybe shocked some people, but turned out to be pretty accurate. So I would say mid of last year, the estimate we had, the ultimate estimate we had, and which was relevant for our capital models, is not that far away from what we now have. So we could see further waves. Maybe we didn't think they would be as strong, but we calculated them. We thought they would come based on historical events. And so I'm very happy about all of these aspects. And then clearly having losses is part of our business, and certainly on the life and health side, that was costed in, priced in, it's in our capital models. So I think the real issue is more around some of the wordings and some of the lines where we were surprised to have some of this pandemic risk hit us. But I think if you ask overall, I think not just us, I think the insurance industry has done a really good job.
Yeah, no, it's clear that the industry's really managed this particularly well, given how unexpected and how far out in the tail a pandemic like this would actually be for the models. But I guess as the CEO of a large global reinsurer, perhaps you could talk us through some of the specific challenges that the industry's had to learn to deal with through the pandemic, and also whether some aspects such as travel you think have perhaps changed for the better.
I definitely think there will be a long-term impact on travel. Obviously, I might be wrong, but I think not just us, the whole industry has learned to do things online much more. So there's all the internal meetings, obviously, but even with clients, it's much more acceptable these days to have online quick touch points, and it's actually much more efficient for many of these interactions. I used to travel extensively, and then as you know, usually it's not very efficient. You have long travels, and then you can only see one client or two clients per day because the CEOs are not available, and now you get all this efficiency. So I think as we look forward, certainly we have announced already that we want to cut travel budgets by 30% going into next year's compared to pre-pandemic levels. But at this stage, we clearly think that's not ambitious enough, and we see other people doing even more. So I think we will also follow suit. And I think it's absolutely possible to cut further, also to cut the footprint that we have, the carbon footprint, which is, air travel is one of the biggest driver of our carbon footprint. And we've committed to net zero 2050, so it all sort of falls in line. So I think really on the operational side, on the IT side, on the travel side, even on the cultural side, I see a big shift in the insurance and reinsurance industry. And I think the one thing really that stood out of learning, so things to improve, is the wording. I think that the wording to be more precise of what risks are covered, what is not covered. It starts with the primary insurers, with their own clients, where clearly there were some issues, particularly in Europe, with not being clear enough, and there's a misunderstanding, and it leads to lawsuits, and that's not helpful for anybody to have this lack of clarity, but also then between insurance companies and reinsurers. And so we need to do our homework, and we need, as an industry, to fix these issues, that we only cover the risks we intend to cover, and that is clear to all parties.
Yeah, that level of transparency in the product itself, I think, is something that's really hit home over the last year. And obviously now we're in a reinsurance market that's firmed over consecutive renewals for a little while now, and that means obviously portfolios are primed to earn out quite attractively, dependent on loss activity, of course. But how do you think this has positioned Swiss Re for 2022 and beyond?
Yeah, we shouldn't forget that there were lots of losses in the industry the last few years. So the pricing levels were clearly unsustainable. And if you stay unsustainable forever, there's not going to be any capital backing you. So I'm really pleased that the industry overall has taken the right steps. And we're back into an acceptable area. And I think we just need now to watch out the long-term sustainability of these prices, because in the end, it's capital at work. We have shareholders and they need to earn their return.
And what about for the renewals coming up in 2022? Obviously, this time of year, people begin to talk about January, and perhaps also considering the impacts of recent disasters in regions like Europe from the floods, where a lot of treaty business is going to renew on January the 1st. Do you have an outlook for the renewals, the Swiss review?
I clearly think prices need to and will harden further. I think what happened in Europe is a stark reminder of the issues that are at hand, including climate change and the impact on secondary perils. And everybody could see it. Obviously, our clients could see it, the clients of our clients can see it, but also our investors can see it. And clearly in the investor community, there's concerns around all of that, which will put pressure on the whole insurance and reinsurance industry to earn the appropriate returns. And then in the US, obviously, you saw Hurricane Ida, no surprise here, but again, a stark reminder of where we are. So I think with all these events this year, I doubt the mood will be to further softening at the end of the year. I think everything I see speaks for further hardening.
Yes, and I guess the Hurricane Ida is really just going to drive that home, and we also have issues like the California wildfires where we're not even into the peak of the season yet, so it does seem there's plenty of room for more surprises and unfortunate events. When we spoke a year ago, we discussed Swiss Re's expanding alternative capital business, and I know this is an area that used to be close to your heart. Perhaps you could give us an update on progress and tell us how important this avenue to access additional sources of capacity while also earning fee income could become in future for the company.
Yeah, that's right, Steve. Yes, as you remember, I was very active in this field 20 years ago, actually, when we did some innovation, including mortality bond, the first mortality cat bonds. So when nobody was talking about pandemics, this was clearly one of the underlying risks which we had to analyze. So I think it's a fascinating field overall. We have a very good team. We're very happy about our team. We have invested quite a lot the last few years. They've expanded the universe of products they offer. By now, we're about 3 billion of assets under management, as we say. So 1 billion is our own fund of cat bonds. So we have a team which has the mandate to do it just for ourselves, for our own balance sheet. Has performed really well, by the way, over the last few years. And then we have 2 billions, which is more in the different sidecars we have. And then the new flagship product, which is a core cat fund we have, which allows investors, qualified investors, to participate into basically the Nat Cat portfolio of Swiss Re. So the same we have, this total alignment of interest, and this is something we launched earlier this year. So we continue to find new forms because there's different investor base, as you know very well, that they're interested in different profiles, risk return profiles, and our team is very active in creating new products. So I believe giving access to the capital market will be one of the valuable things we can also bring to our clients.
Absolutely. I mean, I do think that the industry is going to rely on external sources of capital increasingly as climate risk becomes something that gets priced for appropriately as well. Would you have a view on that at all? Do you think the climate conundrum could be somewhere where the capital markets could be really valuable?
Yeah, I think if you think about it, for most reinsurers, they're at capacity limits for these big perils like earthquake California and tropical cyclones, hurricanes in North America. And yet the protection gap is huge. So only, 15% of Californians' houses are insured against earthquakes. So as hopefully the protection gap gets filled, the reinsurance industry cannot fulfill that role. So that's always my argument why we need capital markets at large to come in. I can also think about other things like pandemics. We just saw it. So if you think about event insurance, this is going to be very difficult and costly for reinsurers because we will have to assume 100% correlation between every event we write, and this will make it very expensive. And so maybe also there's a place for capital markets. So I definitely think there is a need, if you think from a holistic society point of view, there is a need for capital markets for some of these risks.
Absolutely. So we're in an area of the economic cycle where inflationary trends have been highlighted as a potential threat to the reinsurance industry. And I know there's been some research from Swiss Re on this as well. And as we're emerging from a more challenging phase of the pandemic, what are you doing at Swiss Re to try to mitigate any inflationary effects on the business?
Yeah, Steve, I think, there's a lot to say to the topic of inflation. It's a very complex topic. So I think nobody should be surprised that after this more or less economic halt we had in the pandemic and the rapid restart, that there's inflationary pressures. I think nobody should be surprised. In fact, we increased the parameter of likelihood of that in the year 2020. And so it had an immediate effect on our risk model and how expensive this is priced into the risks we take. But we also think this is a short-term thing. This is not a 10-year tendency. It's just a natural recovery effect you have now. Then on the longer tail lines, some lines are not really exposed to inflationary pressures like life and health because they have fixed payouts, but some are, like US casualty, for example, where the issue is not so much CPI inflation. The issue is what is superimposed inflation, social inflation. So basically how people and judges and juries what is their feeling about how much should be asked for companies for doing certain things. And that's not really correlated to CPI. That has a different cycle. So if anything, that is more the topic we are analyzing and looking at very closely, and which has led to significant shifts in our portfolio in the last few years. And then everything that is new business, obviously, we have parameter task forces that analyze the situations and basically try to capture all the information we have at this point in time for all the types of inflations and put them into the pricing models which we use to price the new business. So hopefully new business will be priced with the best information available at this point in time.
And yeah, I suppose that's another driver for potential firming to continue as this inflationary environment at the moment. Moving over to sort of the subject of resilience and global resilience, which I know is an area you do a lot of work personally in. Would you say the insurance value chain is fulfilling its purpose of helping to make the world more resilient? And do you think there's improvements that could be made to the value chain which would help to boost resilience around the world?
Yeah, Steve, it's interesting you say that because the way I explain the purpose of Swiss Re internally and externally is that we make the world more resilient. And I think it's a great purpose to have because it's extremely visible. There's tons of examples that can be given. We basically take premiums from all over the world and then pay those who need it the most when there's a natural catastrophe, for example, or if there's a loss of life. And so clearly it makes the world more resilient. But it's not just true for Swiss Re. I think it's true for the whole insurance industry. And before I go to the shortcomings, I'd like to stress that the insurance industry has maybe not the reputation it deserves for the work it's doing in the world. It has a massively important role to do. It's maybe not a loved industry, but it's doing a fantastic job in making the world more resilient. There will be nothing could be built or happen. There could be no planes, no bridges. Nothing would happen without insurance. And when things happen, insurance, and you can see that economically, the economic recovery is much bigger if there's insurance and reinsurance in place after the event, because the money flows back immediately, can be reconstructed. And if insurance and reinsurance is absent, it's much more fragile. Systems are much more fragile. So I think I just need to make that point, how I think important the purpose of the insurance and reinsurance industry is. Now, you also know about the protection gap. So there's significant economic losses every year that are not covered. It's half or more than half across the world, depending which lines of business you add. And that's been a source of, let's say, frustration for the insurance industry for a long time. I know that from CEOs, we talk a lot about that, because of course it's also business potential that is lost, but it's also seeing the consequences then of big events on all these people, and the money not going there, and no ability to rebuild, and an economic drag being created for years and years and years. It's sort of painful to watch this combination. And so the question is really, how can you close the protection gap? Some of it is closing as countries get richer and people have more money and they spend it, but that's not the only thing. I think there's many more things we need to do, including taking costs out, making more attractive, using technology for all steps of the value chain to make it easier to buy, more risk sensitive, giving feedback on the risks people take. I mean, there's many things that can be done, hopefully over the next decades, to make it more attractive and have just more people buy it.
Absolutely, yes. It's a constant sort of source of disappointment for some in the industry that the protection gaps exist, but really that is the ultimate challenge for the industry, to try and improve its product and processes to help close that. Now at Swiss Re, you've had a significant focus on the subject of secondary perils in the last few years. It's been a topic that's been widely discussed in some of your reports. And do you feel that climate change is moving certain perils to become primary rather than secondary? This is something that's been discussed recently in some industry forums. And how do you as a reinsurer adapt to that? Is it just another case of having to stay on top of the latest information and data?
Yeah, maybe we need to explain to the audience, primary, secondary peril. It's a bit of strange, wording. Primary perils usually were the perils that buy the most capital because they're rare and extremely big. And so it's hurricanes in the US, it's earthquakes in California, it's windstorms in Europe, for example, typhoons in Japan. So that's what we call primary perils. They're multi-billion impact. That can be multi-billion impact. And then there were these secondary perils, so-called, floods, droughts, fires, which from an economic loss and insurer loss perspective were small compared to the primary perils. And the last few years, we saw the cost of those increase much more in proportion, which led us to obviously constantly study the science of climate change. What do the scientists know? And the interesting fact is that on the primary perils, hurricanes, for example, there's no consensus yet that climate change is making them more frequent or more dangerous. I'm not saying it's not the case, but it's just at this stage, there's not enough data and proof. Whereas on the secondary perils, there's clear scientific consensus that climate change is already visible, is making them worse. And you can see how they start to become much more important. And actually, your question is spot on, because if you look at winter storm Uri in the US this year, the loss is about 15 billion. So it gets into the scale of a hurricane, and it's the biggest loss we ever had from this type of event in the US. So we are adapting the models clearly. Everybody has to adapt to the new realities, but unfortunately, we clearly see the consequences of climate change.
Absolutely. It's another interesting area where events like Winter Storm Uri deliver losses to the industry that are not just from the weather event itself, but from the knock-on effects of a weather event, which perhaps just shows us how fragile the world can be. So finally, as I don't want to use up too much of your time today, Christian, I thought maybe I'd ask you about the recent IPCC climate risk report, which really provides a stark warning for us all on the potential for climate change to increase impacts and costs of weather disasters. So what at Swiss Re are you doing to ensure this is priced for in your risk taking, of course, but also to ensure at the same time that your capacity remains as affordable as possible to make it as useful as possible to the world as well?
Yeah, I think climate change is obviously close to our hearts, and I think that's because on one hand it touches us on the loss side, but also because we are seeing it. We're early, we're at the forefront of the events, and I think the reinsurance industry has seen this coming much earlier than the rest. And I think this puts a lot of responsibility on us to warn the world, to tell what we're seeing, and that's what we have tried to do for decades now. I think it's important to note that the insurance and reinsurance industry cannot solve climate change. Climate change is not a risk. Climate change is a trend. It's a fact. You cannot insure facts. Okay? So the trend line over years will be borne by societies, not by the insurance or reinsurance. We cover volatility, deviations from the mean. And so there, clearly, we try to update the models. That's our role in society, also to give a message back to the carriers of risk or to the people who construct houses, etc., what it costs, and to hopefully steer it towards methods of building stronger, not building houses in floodplains and things like that. So I think that's really the role we take. We cannot make it, cheaper, more affordable. We can maybe a bit through cost cutting, but overall, we are not the solution to climate change. We are just warning about it and giving pricing signals to society to hopefully finally take it very seriously.
Yeah, and those pricing signals, I think, are going to become increasingly important for the economy as a whole. And as you say, insurance has an enormous role to play in providing those, and responsibly pricing risk, I suppose, is at the heart of all of that as well. Look, Christian, thank you very much for your time today. I really appreciate it. It's been a pleasure to talk with you again. Hopefully we might be able to do this in person within the next year rather than over a screen, but we'll see how that goes. So thank you again for your time. It really was a pleasure talking with you.
Thank you, equally, and hopefully we see each other physically next year.
Thanks, Christian. Bye-bye.